The stock market has always had its ups and downs, crashes, rallies, panic, euphoria. But today, it's different. One speech, one headline, one algorithmic trade, and the entire market moves. Fast, brutally fast. April 2025 proved it. Trillions wiped out in hours, confidence shaken in minutes. So when I say the stock market is getting chaotic, I don't just mean volatile, I mean faster, louder, more reactive, less logic, more noise. And while most investors are left scrambling, the smartest investors in the world, Warren Buffett, Michael Burry, Bill Ackman, Howard Marks, and Mohnish Pabrai, aren't surprised. They've built their entire playbooks on moments exactly like this. The question is, what are they seeing in the chaos and what can you learn from it? Because chaos isn't the enemy. Confusion is. Let's clear that up. For this, we need to go back to the April stock market drop that didn't just come out of thin air. Markets were already shaky. Inflation had been running hot for months. The Fed's messaging felt uncertain. Valuations stretching far beyond fundamentals. Tech was inflated. AI hype was boiling over. It was a bubble waiting for a trigger, and that trigger was political. When Trump made his tariff announcement, he didn't just launch a trade war, he disrupted investor confidence. Suddenly, the question wasn't, is the market expensive? It was, how bad could this get? But here's where smart money separates from scared money. Regular investors panic because they don't have a framework. They react to headlines. Super investors like Buffett, Burry, Ackman, Marks, and Pabrai have spent decades building mental models for exactly this. They don't ask, what just happened? They ask, what really matters here? Is the crash about politics? Or is it about fundamentals? Are prices overblown? Or are opportunities being uncovered? The real question isn't why the crash happened. It's what it revealed. About fear, value, and clarity. And that's where we go next. So let's strip away the noise for a second and look at how the smartest investors think before, during, and after chaos. Start with Howard Marks. He calls predicting the future a losing game. Instead, he focuses on what's actually knowable: company fundamentals, cash flow, debt, and value. His strategy is bottom-up, not forecasting, but filtering. The same is the case with Warren Buffett. His rule is simple: be fearful when others are greedy and greedy when others are fearful. When markets melt down, he waits. His edge is patience, and he's sitting on over $300 billion in cash right now for a reason. He's not out of the market. He's hunting. Then there's Mohnish Pabrai, a student of Buffett, but even more laser-focused. He avoids complex stories, trendy sectors, and high risk. His filters? No debt, high moat, low maintenance. He once said, "Don't buy businesses you wouldn't hold in a hurricane." His portfolio is full of boring stocks, and that's the point. He makes peace with not knowing the future, and that keeps him focused on the present. For Pabrai, boredom is a strategy, simplicity is the edge. Bill Ackman plays the game differently. He doesn't diversify like the others. He makes bold, concentrated bets, but always with data and conviction behind them. He was one of the first to call COVID a catastrophe and hedge for it. In 2025, he's been outspoken again, criticizing Trump's tariffs and calling them economic sabotage. But he hasn't dumped everything. And finally, Michael Burry, the contrarian of contrarians. He bets against the crowd, called the housing crash in 2008. He's been bearish on China, cautious on tech, and quick to shift when risk outweighs reward. He doesn't talk much anymore, but when he does, people listen. In the first quarter of 2025, he rotated out of Chinese positions, anticipating trouble. And look, they all have different strategies. They invest in different sectors. They speak in different tones. But here's what unites them. They don't trade on fear. They don't chase headlines. They don't try to guess tomorrow. They build frameworks. They trust their process. They move when it makes sense and stay still when it doesn't. Because smart money isn't about being fast. It's about being right. In short, different tactics. Same core principle. Don't react fast. React right. And that principle was put to the test the moment the ground shook on April 2nd, 2025. President Trump walked onto a stage in Michigan, flanked by American flags and auto workers, and announced what he called Liberation Day. With one speech, he imposed sweeping tariffs on Chinese and European goods, steel, semiconductors, electric vehicles, pharmaceuticals, Nearly $500 billion in trade was suddenly taxed. Markets reacted badly. By April 3rd, the S&P 500 had dropped over 6%. By the next morning, it hit nearly 10. The Nasdaq lost even more. Within 48 hours, more than $6 trillion in value had evaporated from global markets. News outlets dubbed it the Trump slump. Investors were blindsided, not because the market moved, but because it moved that fast. Within a single week, portfolios were down double digits. Traders froze. Algorithms dumped. Retail investors ran. But what's crucial is what happened next. By mid-April, Trump walked back parts of the policy after mounting pressure from CEOs and foreign diplomats. By May, some tariffs were delayed or paused, and just like that, the rebound began. Tech stocks recovered. Industrials surged. By mid-June, the S&P hit an all-time high. If you'd panicked and sold in April, you'd have locked in your losses. If you waited, you saw the full swing. And this is exactly what the smartest investors understand, that markets aren't machines of logic. They're machines of emotion. When policy shocks hit, the first wave is fear. The second is reaction. And the third, the one that matters, is opportunity. Burry got out early. He made his move before the storm. According to his Q1 filings, he rotated out of several Chinese tech positions and loaded up on puts to make quick money. Buffett held steady, even parking cash in record-breaking treasury bill positions. Ackman sounded the alarm, calling the tariffs economic nuclear war. But he didn't sell. Pabrai stayed steady. And Howard Marks? He didn't talk much. He just watched, patient and grounded in cycles, waiting for clarity. They all approached it differently, but none of them bailed. None dumped their portfolios. None ran from the market. Because they've all seen this movie before, and they know that headlines make noise, but patience makes money. This wasn't the first shock, and it won't be the last. Now let's talk about the people who don't have billion-dollar portfolios. Regular investors. People like you and me. Why do we make the exact opposite moves of the smartest investors at exactly the wrong time? It's not because we're dumb, it's because we're emotional. When the market crashes, our brains go into threat mode. The headlines scream, the numbers turn red, our portfolios shrink, and it feels like if we don't do something right now, we'll lose everything. That panic instinct kicks in. Fight or flight. But in the stock market, flight is usually fatal. And here's the irony. The biggest up days in market history almost always happen right after the worst down days. That's not an opinion. That's math. Today's market moves faster, reacts harder, and punishes hesitation more than ever. Missing a day doesn't mean missing a dip, it means missing a comeback. From 2003 to 2022, if you stayed invested in the S&P 500, your $10,000 would have grown to over $64,000. But if you missed just the 10 best days, you'd be down $35,000. Miss 20? You're worse off than when you started. Miss 30? You're toast. And here's the kicker. One of the best days in that whole stretch came immediately after one of the worst. Back to back. No time to get out. No signal to get back in. Timing the market doesn't just require luck, it requires perfect luck. Twice. Which means every time you try to time the market based on fear, you're not protecting your money. You're just handing over long-term gains. This is what smart money knows by heart. Buffett doesn't panic because he's seen it 1,000 times. Burry doesn't react. He prepares. Ackman hedges instead of fleeing. Pabrai just ignores the noise. And Marx? He calls it how it is. Trying to get in and out of markets based on emotion is just a game most people will lose. The game isn't timing. The game is staying in long enough to win. Let's zoom out and talk about one of the biggest variables in this entire story. China. Because while Trump's tariffs dominated headlines in the US, their real impact was felt across the Pacific. Chinese markets, already under pressure from a slowing economy and property sector stress, got slammed. And that's where smart money saw not just risk, but potential. Michael Burry had already stepped away. In his Q1 2025 filings, he'd exited Chinese tech stocks like Alibaba and JD.com. He saw a storm coming, and he wasn't interested in gambling on a rebound. His bets shifted to U.S. defense contractors and agriculture, sectors less exposed to trade wars, more connected to hard resources. Howard Marks, though, thinks differently. He's long said that the word uninvestable is music to his ears. He sees pessimism as the place where bargains live. And right now, China is a pile of pessimism. He admitted the risks, policy uncertainty, regulation, macro headwinds, but he's also clear. Prices already reflect that fear. If you wait for good news, the value's already gone. Warren Buffett has warned repeatedly about turning trade into a weapon. At his shareholder meeting, he noted that while China's political system may differ from the West, their economic drive is undeniable. He believes in long-term fundamentals, not short-term politics. But he also knows trust drives markets, and weaponizing trade chips away at that trust inch by inch. Bill Ackman is more cautious. He's focused on U.S. resilience and prefers to avoid geopolitical complexity. His positions are closer to home, businesses he can model precisely, without the fog of international policy risk. But even he hasn't ruled out a return to emerging markets if the policy climate stabilizes. He's not anti-China, just waiting for clarity. By now, you've seen how 5 of the sharpest minds in investing handled chaos. They didn't all agree. They didn't all act the same, but they shared one thing: clarity under pressure. So how do you think like that, even if you don't have billions? First, stop thinking you need to outsmart the news. You don't. Buffett doesn't try to forecast elections or central bank moves, and neither should you. What matters most is behavior, not predictions. You don't need to know what happens next. You just need to know what you will do next. Second, own what you understand. Seriously. You don't need to analyze every sector. You don't need to find the next Tesla or the next crypto coin. If you stick to businesses you actually get, what they do, how they make money, and whether they're priced reasonably, you're already ahead of 90% of investors out there. Third, keep some cash. Not because you're scared, because you're smart. Opportunity never arrives on schedule. Crashes don't wait. They slam the door. And if you're the one with cash when prices go down, you don't panic. You pounce. Fourth, avoid extremes. Don't go all in on one idea. Don't yank everything out after one bad headline. That's how good investors get stuck in bad decisions. Pabrai spreads across quiet, undervalued companies. Ackman hedges. Marks keep liquidity. Fifth, zoom out. Always zoom out. A bad month is noise. A good decade is wealth. The market always feels chaotic in real time, but from a distance, the patterns are clear. History rewards the patient. You don't need a perfect IQ. You need a plan. Every time the market crashes, it feels like the end of the world. But here's the truth. It never is. The dot-com bubble felt like the end. The housing collapse in 2008 felt like the end. The COVID crash in 2020. Same story. Every one of them sparked panic, headlines, and predictions of a lost decade. But every single time, the market came back, stronger, higher, and with new lessons for those who stayed in. So when people say this time is different, they're usually right about the cause, but wrong about the outcome. In 2025, the Trump tariffs may have kicked off the chaos, but the pattern? It's familiar. Policy shock, investor fear, overreaction, and then, over time, recovery. Maybe not instantly, maybe not cleanly, but steadily. Smart money understands this cycle. Buffett talks about market cycles like seasons. Sometimes it's summer, hot, inflated, overvalued. Sometimes it's winter, cold, scary, and full of doubt. But spring always comes. It just takes patience. And that's where most investors slip, not in analysis, but in endurance. Howard Marks wrote about it in his memo, that cycles are built into the system. Human emotion drives markets more than fundamentals do in the short term. And that's why volatility isn't an anomaly. It's the cost of admission. It's what you pay to get rewarded over the long run. And here's the thing. You don't need to be perfect. You just need to not quit. The people who lose in markets aren't the ones who get a few calls wrong. They're the ones who stop playing. So, if you've felt shaken this year, it's okay. Everyone has. But don't mistake normal chaos for permanent damage, because this isn't the end. It's just another dip in a long, upward climb. Here's the truth. The market will crash again. Maybe next year. Maybe in 5. Maybe from something we can't even imagine yet. But it will happen, because chaos is part of the game. The question is, what will you do when it does? Think about how many people gave up in March 2020 only to miss the fastest recovery in modern history. Or in 2025, who sold in April and missed the June rebound. Timing the market feels smart, but staying invested is smart. Want to know the 4 things that always happen before a major crash and how all 4 are showing up in today's market? Click the video on screen to find out.